Thrivent's a unique company. Just quick show of hands, and I'll just give you a brief overview on our firm. Has anybody here heard of Thrivent Financial before? New company? Maybe one person? Okay. That's not uncommon. Actually, Thrivent's been around for over 100 years, and we're actually a Fortune 500 company. We have over $100 billion of assets under management. But one of the reasons that a lot of folks haven't heard of us before is for the last about 100 years or so, we've been actually only open to the Lutheran community. 2 years ago, actually, our members voted to open up our membership to all Christians. So Thrivent is not open to the public. It's a Christian-owned, member-owned organization that does comprehensive financial planning. So very unique in our structure. So after our operating expenses, all the profits of the company go back to the members rather than the stockholders like most companies. But the other thing that's so unique about us and why we work with a lot of churches is that we're a not-for-profit organization. So we actually get to give back taxes that would normally go to the government on those profits, and we actually get to give it right back to the churches that we work with, seminary schools, things like that. So last year we actually gave back nearly $200 million, and every year that number continues to grow. So it's an exciting story, and it's really exciting for Ron and I to sit down with a lot of folks, and appreciate the opportunity here today, John. But just to kind of share our story, because a lot of folks haven't heard of us yet. And today we're going to talk about overall financial planning, which we'll try not to make it too dry and try to, again, make it somewhat entertaining for you. In front of you, each of you has a book, our More Than Money Matters book. And this is a useful tool that a lot of our churches utilize to kind of talk about the basics of financial planning. We'll maybe get some handouts here. And this can either be led by a representative or it can also be member-led, like John mentioned. So this is something that you can implement in your congregation. But it's really designed to help people with a lot of the basics of financial planning and really help them on that journey to be good stewards of their money. And this is normally a 4-week course, and about an hour for each course. I was told I had about 45 to 50 minutes to kind of squeeze this all together. So what we're going to do is we're going to hit some high level points. We actually put a PowerPoint together to kind of keep us on track. But there's a lot of additional details actually in the workbooks in front of you. But we'll just try to hit on some key points. Okay. So first off, and each of you actually has a financial pyramid in front of you. And these are really the building blocks of any good financial plan. So you maybe see that in front of you. And the topics that we're going to cover today are strengthening your overall financial position, protecting your future, saving for your goals, living in retirement, and then ultimately planning for your legacy. And the first topic, and you'll see it actually at the base of that pyramid, and I think any financial advisor would probably give you this advice, that you want to start off with, is you want to save in the event of an emergency, right? Life happens. And everybody differs a little bit as far as how much they recommend you should have set aside just in case of an emergency. CFP textbook answer is somewhere around 3 to 6 months of your living expenses. So again, emergencies happen. They're just going to happen. Life happens. And you want to make sure that you're prepared. And 3 to 6 months of living expenses, what that should cover are the things that you can't live without. So that's your mortgage. That's your rent. Okay, that's your groceries. It's your car payments. It's your utilities. It's your health insurance premiums. It's the things that will be there regardless. These are not optional expenses. They're going to be there. And you just want to make sure that you're planning accordingly. Having a proper emergency reserve fund is going to save you from going to the credit cards, which we all know is not a good thing. Sometimes it's a necessity, but with the emergency reserve position in place, it really alleviates some of that temptation. And a lot of folks, and this either maybe pertains to you or it could pertain to some of the obviously folks that you work with in the churches that you're going to serve, but they might say, well, that all sounds well and good, but how am I going to get to 3 to 6 months of living expenses? I'm living paycheck to paycheck. Well, one of the things that we really advise our clients to do is to set a goal, set a reasonable expectation, set a goal that is attainable. And if you can start with $1,000, just start with $1,000. Again, maybe put your budget on a diet a little bit, become more energy efficient, don't eat out as much. Get a bundled package with your cable and internet provider, whatever it is, okay? But just come up with some savings and start with that baseline. A lot of advisors will tell you that a lot of the expenses that come up, whether it's the tire blowing out in the car, the water heater, the roof leaking, whatever it might be, can be covered with that $1,000. And then from there, it's a matter of automating it, okay? Setting it up systematically where every single month a certain amount is coming out of your paycheck or out of your bank account just to build up that reserve so you ultimately get to the 3 to 6 months worth of expenses. The other main thing that I know is a source of conflict for a lot of us is kind of the budgeting and the cash flow. And actually in your workbooks that you have in front of you, I think there's a lot of useful tools that you can really look at. And again, either for yourselves or maybe for some of those that you're working with. But one of the key things is just first off, understanding what you're spending your money on. Okay, and a lot of folks don't have a budget. It's very common. Don't feel bad if you don't. You're not alone, trust me. And one of the concepts that we try to incorporate is really the 10-10-80 concept of the first 10% of your income you want to share, meaning it's all God's anyway, but first 10% is tithe. The next 10% you pay yourself, meaning you're putting it away into a retirement account or a college savings account or your emergency reserve is where it should go if you don't have that built up yet, or paying down credit card debt first and foremost. But then the last 80% is for you to spend. And staying within those guidelines, I think, is really helpful. It helps you stay on course, but it also maybe helps align your spending habits with what your values are. And one of the other things that we always try to tell folks to really understand is the concept of opportunity cost. Show of hands, who knows what opportunity cost is? It's an economic concept. Well, what it is basically if you spend money on A, you forego what you could have gotten with B in essence. Meaning if you're going to make a major purchase, one of the things we really advise folks to do is to really stop and think about it for a while, especially a major purchase. Take a breath, take a day, pray about it, talk about it. And then really come to the conclusion of, if I purchase this, is this really going to align with my core values? Is this going to help me meet my goals? Is it worth it? And if after that 24 hours you say, yes, I'd say go for it. But at least you took that opportunity to really think it through intelligently and have an idea of what you're getting into. And what that does is it really helps you stop what we call our spending leaks, right? Where there are things in the budget that you don't realize that are there, but they are. And that's simply because you just spend without thinking it through, without talking it through, without having an understanding of it. And it all comes back to ultimately developing what we call SMART goals. Okay, SMART goals are specific, they're measurable, they're achievable, they're results-based, and they're ultimately timed. And what these goals should do is they should align with your values. And I think there's a real helpful sheet in the workbook that you have there, and again, I'm just kind of going through this quickly, that really talks about different values. It's actually on page 4, and I'd encourage each one of you, when you have some time, to really go through and circle or highlight what are your core values. And based on that, how do your spending habits affect that? Meaning, are you spending in line with what your values are? Is where the money going ultimately reaching or helping you reach some of those goals that you've laid out? And God really talks about this. Proverbs 21:5, the plans of the diligent lead to profit as surely as haste leads to poverty. Meaning, He wants us to be good stewards of our money. He wants us to plan, and He wants us to act accordingly. Okay? Any questions on anything I've talked about so far? No, probably pretty straightforward, but stop me with anything. Okay. Big thing that a lot of advisors will talk about is managing your debt. And there's both financial and certainly emotional costs that result from debt. Financial costs are the obvious. We're in a zero interest rate environment today, meaning we've never seen rates as low as they are at this present moment, yet I don't think anybody told the credit card companies that, right? They're still charging you 15, 20, 25% even on the cards, right? So that's not a good use financially of your assets. But what about the emotional costs? Raise of hands, what are some of the emotional costs that result from debt? Stress, anxiety, you got it. You probably are a better resource on this topic than I would be as far as the emotional costs around this, but I've read a lot of studies where a lot of the conflicts in marriages and divorce and so forth are money related. A lot of that is tied to some of the stresses associated with debt, the conflict in values maybe, meaning that debt is not allowing you to ultimately reach the financial position that you aspire to be in. And so I think everybody would agree that it's important to really manage your debt and to get a handle on that and to be wise around that if you do have credit cards. And some real basic techniques that I think everyone should hopefully take away from today if you do have unsecured debt or credit card debt is, first off, cut up your credit cards if you can. Okay? Maybe keep one that's there for an emergency, and don't keep it readily available, meaning don't put it in your wallet. That's just going to lead to temptation, right? Put it somewhere maybe in the house that it's hard to get to, meaning you really got to try to get to it. And that'll stop you from using it. Okay? And then cut up the rest of them. And then from there, the obvious thing is, anything you can above that minimum payment, pay it. Anybody know if you just make minimum payments, how long it's going to take you on average to pay off a credit card debt? 37 years? Forever? Yeah, pretty much. I think on average, I was actually curious on this. I looked it up on the way over here. It's about 22 years on average. Some are higher than that, obviously, depending on how it's structured. That's ridiculous. That's a mortgage, right? You just make those minimum payments. You're going to have that credit card debt as long as you have your house, for the most part. So anything that you can do above and beyond that, again, put towards those debts. With the interest that they're charging you right now, it's obviously a very good use of your money. And so how do you go about doing that? Well, again, in your workbook, there's actually a worksheet that I think is helpful. It's on page 68. And again, those are your workbooks to take home. But it's a worksheet that really helps you identify maybe all the various credit card balances that you have out there, where you can identify them, but also identify the interest payment on each, or the interest that's being charged, I should say, on each. Well, simple technique that I think makes quite a bit of sense is start attacking as much as possible those highest interest rate charges right away. So if you got 3 credit cards, one's charging you 10, one's charging you 15, one's charging you 20, put as much as you can towards that one that's charging you 20. Okay? Get rid of it as quickly as you can. Once you have that paid down completely, then take the money that you're applying towards that and put it towards the next highest interest charge, the one that's charging you 15%. And slowly but surely what will happen is you'll really have what they call a debt snowball effect, and you'll be debt-free, which will be an incredible relief, not only from a financial standpoint, because you now have that cash freed up that you can put towards good uses, like saving for retirement or other uses that might be out there. But also you're free from that emotional aspect of the anxiety, the stress, all of those things that typically accompany debt. And again, the Bible talks about this, Romans 13:8. Let no debt remain outstanding except the continuing debt to love one another. We want to be debt-free as quickly as possible. It's easier said than done, but there are techniques out there to make sure that it happens. Creating an emergency reserve fund to make sure that you don't have to go to the credit cards in the event of an emergency. Budgeting, so you understand where your money is going and avoiding those spending leaks. And then if you happen to find yourself in debt, some techniques about paying those down as quickly as possible. Okay. Questions on that? You guys are easy. The next kind of baseline topic that we want to talk about in the financial pyramid really revolves around protecting your future. Everybody's favorite topic, insurance, right? The first pillar of that really is life insurance. And in essence, what life insurance does is it helps you complete those goals that you weren't able to complete on your own, right? So we talked about how you want to create goals, you want to be smart, you want to create those goals ultimately for you and your family, but if something unforeseen were to happen, you want to make sure that life doesn't derail and that you have enough money there to protect you. And I saw some studies around this. Actually, LIMRA, Life Insurance and Market Research Association, came out with a study, and right now about 60% of people own life insurance, which is a little bit scary because that means 40% don't. Okay? But 1/3 of those folks that actually own the life insurance admittedly say they don't feel they own enough, meaning if something were to happen to them, they don't think their goals would be completed and their family would not be taken care of. 43% of them said that they think that their spouse or their family would have trouble actually paying everyday expenses within 6 months. Okay? meaning this is a major need that's out there and you have to protect yourself and your family. Well, how do you go about doing that? Term versus permanent insurance. My answer would be, it doesn't matter. Focus right now on the amount. Make sure that you're covered. Make sure that your family's going to be okay. And then have some of those other conversations around that later. Who knows, there's a lot of different rules of thumb out there, but approximately how much life insurance you should own, industry average. Anybody? There's a couple different rules of thumb. And first off, I'd say that everybody's different. That's why you want to sit down with a professional, really, to take a look at your financial situation and see what makes sense for you. But one rule of thumb is 10 times your salary. So if you have a $50,000 salary, you should have somewhere around $500,000 of life insurance, which would be there to help replace, again, loss of income. Another rule of thumb that a lot of advisors will give you is the 4% rule. Some of you maybe have heard of that. But what the 4% rule is that's actually the withdrawal rate that a lot of economists say you can take out of an investment, adjust for inflation, and have a high statistical probability of not running out of money. So what that means is that if your family needs $40,000 to live on for the rest of their life, and you want to make sure that that's still going to be there coming in for them, you're going to need about $1 million of insurance. Okay? Just facts that are out there that you just want to be aware of, not only for yourselves, but also some of the folks that you work with inside your congregations to alleviate some of those concerns. One of the other topics that we wanted to just briefly touch on is disability insurance. So this is in place that if, to be blunt, you don't die, okay, but you're unable to go to work, whether it's due to an injury or a sickness, the bottom line, your bills are still going to get paid, okay? And Social Security actually came out with a statistic that actually surprised me quite a bit. They said actually 1 out of 4 20-year-olds right now, at some point between now and age 67, will become disabled, whether it's due to a sickness or some type of an injury, where they're unable to go to work for a period of time. You want to make sure that you're planning for these things so that all your goals, all of your ambitions as far as your financial situation is concerned are completed. Because if something happens, you want to make sure that those bills are still paid. Questions on that? You good? Okay. Next up, wills and trusts. And again, I'm not an attorney. We're financial advisors, so we do a lot of personal planning. And I'm not going to talk a lot about this, but a lot of people walking around right now without a will. Okay? That's a little bit scary, especially if you have kids. Okay? I got 2 young kids at home. A couple things that I always want to make sure of is that, one, I have enough life insurance that if I don't make it home today, my wife's going to be okay. And that everything that we planned as far as college and everything else will still be taken care of. But I also want to make sure that I have my will updated and in place. Because if something happened to both of us, I don't want the courts naming their legal guardian, right? It's important. So if you have young children, or if you have a dependent with special needs as an example, make sure that you're getting these documents in place. Because again, if you're like me, the last thing you want is the court kind of making that very important decision for your family. The other thing I'd say is a trust can be very, very important to help avoid, first off, probate. And if anybody's ever been through a probate process, it's not pretty. It costs a lot of money. It takes a lot of time. In a lot of cases, it's unnecessary. But the other thing that a trust will do is it's going to provide management and assistance for your heirs, meaning, especially, again, if you have young kids, they're not going to be able to manage their financial affairs. Or it could even be older kids, right? And I have a lot of clients that have done this, meaning their kids might be in their 40s or 50s, but they still don't trust them to make wise financial decisions. So for their own protection, the money is held in trust for them to make sure that it's always going to be there and irresponsible decisions aren't made. So just things like that. You just want to make sure that you're aware of how they all work, not only, again, for yourselves, but to avoid maybe conflicts in the future. Anybody know who this is? Pretty smart guy. The next topic is really kind of talking about saving for your investment goals. Einstein had a great quote, "Compound interest is the 8th wonder of the world. He who understands it earns it, he who doesn't pays it." Okay? And that's really important, especially if you're maybe just starting off, or even you're just getting going as far as your retirement savings is concerned. Because compounding interest is an amazing thing. This is an interesting chart JP Morgan came out with. I think it really does a good job of really describing this, where you take a look at the left, you have Susan. Susan invests $5,000 annually between the ages of 25 and 35. So she saved for 10 years, and then she didn't save again, right? She was done. Then you have Bill right next to her. He saved $5,000 annually between the ages of 35 and 65. So in total, he actually saved $150,000 compared to her $50,000. So you'd think at the end, when they're both retired, obviously Bill would have more, right? He doesn't. By age 65, you'll actually notice that Susan has over $562,000 compared to Bill's $505,000, assuming a 7% rate of return over that 40-year period of time, which I think a lot of economists would tell you is actually a pretty conservative rate of return over that long of a period of time. Compounding interest, because that money was working and compounding that much sooner, even though Susan invested $100,000 less than Bill, or only invested a third of what he did, she still ended up with more. You now look at the far right, you have Chris, who invested $5,000 annually throughout the entire period of time, from 25 to 65. He was the diligent saver that didn't stop. Okay? His $200,000 today is worth $1 million. He's retiring comfortably, and all he did was put away $5,000, and he didn't even adjust for inflation. He just simply was diligent, put it on automatic pilot, and just did it every single month. And at the end of that period of time, he let compounding interest really take over. Pretty powerful. And again, it just really reinforces that as soon as you can, again, find those spending leaks and plug them, get rid of credit card debt, things like that, and start putting away into retirement accounts or investments for yourselves, the better off that you're going to be. What's the big problem, though, with a lot of investors? They can't get out of their own way, typically, right? If you look at and this is kind of an interesting statistic, I think, last 20 years, if you look at the end of 1993 through the end of 2013, S&P 500 actually did over 9% a year, which surprises a lot of people because you think about that period of time, right? You had the dot-com crash, you had 9/11, you had the Great Recession of 2008, which is the worst economic downturn that we had seen since the Great Depression. Yet if you stayed the course and you didn't sell at the wrong time, you stayed invested, over that 20-year period of time, you got over 9% return on your money. But what did the average investor get? About 3%. They barely kept pace with inflation. Why was that? They were consistently doing what we know we shouldn't do, which is buy high and selling low. Meaning, the market's a roller coaster, which in the short term you can't trust it, but long term, while it goes up and down, over long term it goes up. And this is a really interesting statistic that Standard & Poor's actually came out with, where they actually track the flows of money. And you'll notice what's happening is, without fail, investors are doing exactly what you know you shouldn't do, right? So when the market was really peaking, and we had that bubble that was really going on, that tech bubble that ultimately burst in 2000, you notice that highlighted point right there is that was about $80 billion of inflows that went into the market as the market was going up. Meaning investors said, oh my gosh, the market's going up and up and up. It's going to keep going up and up and up. I got to invest. They started investing at the top. Then what happened? Okay, market went down. We had the tech bubble burst, I should say. We had 9/11 happen. And right as the market was really plummeting, there in 2002, they started getting out. So they bought high, they bought at the peak of the market, let the market come down, and sold low. Then what happened? The market started going back up again. 2007, remember that? Market was an all-time high. People started investing significant amounts of money again. Then what happened? The market dropped. We had 2008, we had the Great Recession, where a lot of investors lost somewhere around 50% on their money. Well, what did most investors do? They started selling low. I can't afford to lose anymore. So they started getting out of the market. And that happens consistently over and over and over again. And the reason I guess that I point this out is that, first off, I think knowledge is key. As we're going through a lot of fluctuations right now in the economy, it's important not to get panicked and to understand what your goals are. What is your time horizon? If your money is allocated for long-term reasons, don't panic. This is what the markets do. They go up and down, but in the long term, they do go up. What can really get you in trouble is trying to time the market and getting in and out of the market, because we know, at least history has shown anyway, that the common investor always does what appears to be the wrong thing of buying shares at an all-time high and then getting out at an all-time low. And that can have major, major, major consequences. You take a look at this, and you take a look at performance numbers, and I'm sorry if this is boring to you guys, but just to kind of give you some facts on this, last 20 years, what you've seen as far as S&P 500 returns, you've had nearly 10%. But if you would have missed just the best 10 days of the market, so keep that in mind, right? 20 years worth of returns. If you only missed the best 10 days, your return dropped to about 6%, meaning you lost about 4% per year on average over a 20-year period of time. That's 80% simple interest. That's a huge, huge miss. But look at that statistic in the middle there. 6 of the 10 best days occurred within 2 weeks of the 10 worst days. So what did most investors do? They're going through those bad days, as far as the market's concerned, got out, sold, saying I can't lose anymore, and they missed some of those best days when they happened. Okay? So just staying invested is so vitally important to make sure that you're realizing the returns that you should over a normal market cycle. Who can see the pattern in this slide right now? There is none. And that's kind of the point, right? Nobody can tell you what sector of the market is going to do better, where to put your assets. Okay? If they do, they're speculating. What you should do, and there's Nobel Prize winning economic theory around this, is you should diversify your assets. Don't put them in one basket, right? Own stocks, own bonds, own international stocks, own real estate investment trusts. Nobody's smart enough to know which sector you should be in and to put your assets there and then get out the next year. And that's unfortunately what a lot of investors attempt to do. But by staying diversified and owning different parts of the market, you're going to have some of your portfolio that's doing very well in some years, some that's maybe not as much, okay? But over the long run, it works. And it also buffers out the volatility of the portfolio, which allows you to be more inclined to stay in, which is, I guess, what I'm trying to tell you should do. Meaning, don't panic. It will be okay. This time is not different, even though it feels like it sometimes, okay? Stay diversified, stay invested, understand what your goals are, and you'll be okay. Tax-efficient investing, I think, right now is also incredibly important. We still have a lot of the Bush tax cuts on the books right now, even though it doesn't feel like it. Taxes, at least historically, are at a pretty reasonable level, okay? Well, I'm of the camp that taxes are probably going up from here, and I'll give you a slide here in a second as to why I think that, okay? But you want to make full, or take full advantage, I should say, of the opportunities that are out there as far as tax efficiency. Things like Roth IRAs. If you don't know what a Roth IRA is, it's a beautiful thing. You put money in, and if you let it sit and grow, you pull it out past 59 and a half, and you've owned it for at least 5 years, all of that compounding interest that we talked about is tax-free. The IRS doesn't get any of it. Traditional IRA can help you out with your taxes today, where you get an upfront tax deduction on money that you put in. And something that's really unique for your situation, something called a 403B with a housing allowance. Meaning, if you're an ordained minister of the gospel, you have the best of all worlds. A lot of folks don't understand this. But everything that I just talked about with a 401k or traditional IRA where you put money in up front, you get an upfront tax deduction. The catch is that while that money grows tax deferred, on the back end, when you withdraw it in retirement, it's all taxable, okay? The negative with the Roth, as much as I like them, is that you don't get an upfront tax deduction when you put the money in. You fund it with after-tax money that grows tax deferred. You pull it out tax-free. But again, no upfront tax deduction. Well, you have a special provision. You have a 403B if it's set up properly through a church plan where you get the best of all worlds. Okay? Unbelievable opportunity. If you take nothing away or nothing else away from today, remember this, and remember to talk to somebody about this, okay? 403B with a housing allowance. Everybody probably knows what a housing allowance is, and if not, we can talk after. But the 403B plan for ministers of the gospel allows you to take the upfront tax deduction just like it's going into a normal 403B, reduce your taxable income today. Okay, so it's giving you tax benefits today, lowering your taxable income. It grows tax deferred, just like everything else. And we've talked at length about compounding interest and what a good thing that is, right? But the huge benefit is then when you're retired, instead of paying tax on that like you would in a 401k, you get to pull it out potentially as housing, okay, as the rules read today, which means you can pull that money out tax-free to cover your rent, your mortgage, your utilities, your landscaping, your furniture, your cable bill. There's a lot of different things that you can pull that out for on a tax-free basis. Sit down with a planner and explore this. It's a unique opportunity that's available for you potentially as an ordained minister, okay? And again, why is tax-efficient planning important? Because tax deferral really does matter. You take a look at this. This is, I don't know if you can see this back here, but this is assuming that you put $100,000 in 20 years, assuming an 8% return. You either put it in a tax-free account or you put it in a taxable account. You didn't earn any more interest, you didn't have any larger rate of return, you didn't put in any more money of your own. But by simply growing this on a tax-deferred basis and cutting taxes out of the equation, you actually wound up with over $160,000 more over 20 years by just simply knowing how the rules work. Okay? You didn't put anything more in, you didn't earn anything more. Assuming that you earned an 8% return, you were paying 25% taxes as the money was growing. That $100,000 in a taxable account would be worth roughly $300,000 in a taxable account. In a tax-deferred, tax-free account, over $460,000. Again, it's huge. And it's especially huge because of this. And I probably don't even have to explain this. Where do you think tax rates are going? We got over $18 trillion of, he's saying down. It's the only person I've ever heard say that. We have over $18 trillion right now of national debt, okay? It's going to get paid. We still have, again, a lot of the Bush tax cuts on the books. If you think tax rates are going to go up, you need to listen up about tax-efficient planning, okay? Get this money off your tax return, get it compounding, be smart about how you're positioning it. Okay? Any questions around that? We're good? But it's easy. Next topic is once you get to retirement, then what are you going to do? And this is what a lot of folks don't hear a lot of talk about. Meaning everything that we just talked about was how you save, how you budget, how you grow your money. But ultimately, you grow your money so you can get to retirement and start spending that money. So maybe now work is an option. And I know with pastors, a lot of times you're maybe never fully retired. I just know that from working with you. But now you're not working for salary. You're donating your time, whatever it might be. You're financially independent, I guess is the best phrase for it. Okay? Well, you got to be careful. Markets are volatile. So I'll tell you all day long that you can trust the stock market in the long term, as long as you have a long enough time horizon. But I'll also turn right around and say you can't trust it all in the short term. And your bills are still going to be there. You're still going to want income in retirement, even if the stock market happens to be down. So what you need to understand is time horizons. And when do you need that money? Okay? Short-term income goals should be allocated with short-term assets. Meaning money that you need this year, next year, 2 years from now, 3 years from now, should not be in the stock market. Because I don't know what the stock market's going to do a year from now or 2 years from now. Neither does anybody else. I can give you an opinion, but do you really want your financial future contingent on my opinion, or somebody else's for that matter? Probably not, okay? So money that you need in the short term, again, maybe the first 3 years or so, and I'd take it a step further out than what this chart is showing, just to be extra safe as far as retirement planning is concerned. But keep that money safe. Keep it stable. Keep it in something that's not going to lose. Intermediate term money. This is money that we still don't want to be aggressive with. We want to be more balanced with its investments. So it's a combination of maybe stocks and bonds. That usually represents maybe the next 4 to 10 years of your plan. Meaning this is money that we still need growth on because inflation and longevity are out there. You can't be too conservative with your money in retirement. The banks are not going to pay you enough to keep pace with inflation. And by the way, there's a good chance you're going to live a very long time in retirement. Okay? That's just where the demographics are going. So you need growth. So with your intermediate term money, you at least need to get some growth on it. But be more moderate, be more balanced with it. And then with your long-term money, and I typically say this is money that you have 10 years or longer to invest. That's where you drive a lot of the long-term growth, where you have plenty of time to not have to get out of the market if the market goes down, stay invested, and get the long-term results that the markets will give you, okay? And this is why that's important. This is actually showing a period of time going through something that a lot of you probably remember. It wasn't that long ago, right? We had the Great Recession of 2008, where basically tail end of 2007 through the first part of 2009, we had an incredible downturn as far as the market was concerned. And if you had invested $100,000, okay, and written it down through the bottom of 2008, your $100,000 would have been worth about $54,000. So if you were panicked, and that was in some of your shorter term allocations that you needed for income needs and retirement, chances are you sold. You got out. I can't lose anymore. I need this money. I need to stop the bleeding. And your $100,000 was worth $54,000. And that wasn't on paper anymore because you sold it. Okay? It's only on paper until you sell. But if you had stayed invested, and that had been part of your long-term allocation strategy, where you could look at your portfolio and say, yes, it went down, but also I'm not going to need to touch that money for 10 or 15 or 20 years so I can stay invested. Look at what happened. The $100,000, yes, it went all the way down to $54,000, but we've seen the market triple from that bottom. And today, if you had stayed fully invested, that $54,000 grew to over $170,000. Okay? That's the difference between having a successful retirement and not. It's important. You just need to understand kind of what the time horizon is for your assets and have a good understanding of how your money needs to be working for you. The last thing that we'll talk about, and I'll open it up for questions here, even though there hasn't been any, is planning your legacy. And this doesn't have to be financial, it can be. But a lot of times your legacy is kind of what's at your heart, right? It's your ministry. And there's ways to plan your legacy now, whether it's a gifting strategy, tithing to your church in a very specific way, gifting appreciated stock, things like that. Or it could be something as simple as with your beneficiary designations when you do pass away. Not all your money is treated the same. There's some of your money that is tax-free. So for example, a Roth IRA or life insurance is tax-free. That's a wonderful thing to leave to your family, to your kids, to your grandkids, because they're not going to pay any income tax on it. There are other assets like stocks or real estate that pass with a step-up in basis, meaning there's no tax when you pass away. Again, another wonderful thing to leave maybe to kids or family. But there are other things that are fully taxable, like an IRA or a 401k, or that 403b with housing. That's only tax-free while you're living. It's taxable when you're gone. That's a wonderful thing to leave to your church or your charity. They don't pay income tax. Leave them the taxable money. Leave your kids the tax-free money. Okay? And there are a lot of other strategies that we implement with our clients all the time that allow them to continue their giving even when they're gone. Things like donor advised funds. If you haven't heard of these, they're really, really unique. And when you're starting your churches, it's something that you should think about and gain an understanding of. These are vehicles that actually allow, and you think about it in a church, right? You have some of your best givers, and a lot of the tithe probably comes from a small percentage of the congregation. Well, what happens when they're gone? You want to plan ahead on these things. And they want to give. They want to continue their mission. They want to continue their tithe to their church. Something like a donor advised fund allows them to continue their tithe in perpetuity. So the mission of the church is still fulfilled from a financial standpoint. Things like charitable remainder trusts allow folks within your church to maybe sell a piece of property that they've been holding on to. Not because they want it, but because they don't want to pay taxes on selling it. Sell it inside of the trust. The trust then allows them to sell the property without paying taxes. It ultimately goes to the church or the charity. They get an income stream off of it, but it's a win-win. Okay? And these are more advanced topics that we won't get into today. But just understand that there's a lot of unique options that are available, not only for yourselves, but also for the congregations that you're going to work within, that can really maximize legacy for yourselves or for the churches as well. Any questions on anything? You know, I was expecting that you would have some questions, so I had this to be right at 45 minutes and then allow for about 10, 15 minutes of questions. But any questions that anybody has? Yeah.
Okay, if you invest, right now, oil is like $40 a barrel.
Yeah.
So you buy a bunch of oil,
Uh-huh.
a year from now, it's gonna double again.
Potentially.
So now your 100,000 you put in there is worth 200,000.
Uh-huh.
Do you have to sell your stocks to get your money back, or how does that work?
You don't have to. And the question was oil. Obviously, we've seen oil drop to roughly about $40 a barrel. You want to be careful. Again, commodities and energy plays and oil specifically can be volatile. But the question was if that happens. So if you bought oil, for example, or oil stocks at $40 a barrel, and they appreciate and you double in value, you don't have to sell. No. So it also depends on kind of how you buy it. So you can buy it inside of a retirement plan. So that money actually could grow and compound, and you wouldn't have to pay tax on that appreciation. So when it went from 100,000 to 200,000, there's no tax on that. Then if you said, look, oil's high now, I want to get out. And again, we advise staying diversified and so forth. But if that happened, you could actually sell it within that IRA or that Roth, and then redeploy it or diversify it into other investments and not pay any tax on it. Now, if you just bought the stock, sure, you could do that. The only advice I give you is wait a year. Because if you wait a year, you get long-term capital gains rates on the sale of that stock, which is capped at 15% as opposed to ordinary income tax. So you'll still pay tax, but you're not going to pay as much tax on the sale of that. Good question. Oil's a tricky one right now. Any other questions? Did that help? Did that answer your question?
Yeah. Well, I'm just trying to figure out how you make money. If you're still in there and you don't take it out, you don't really have it.
As far as in retirement accounts?
I mean, I want to buy a house and you got one side up over there.
Yeah, you're right. You need to sell the shares to then pull it out to buy a house. Yep. So, and you can absolutely do that. So what I'd say there is, again, if that worked out for you that way as far as the oil stocks are concerned, I'd say just wait at least 12 months because the IRS is going to get less of a cut of that profit. But then once you sell, like I said, so it can be a positive, right? So I've been harping on don't sell low because it's on paper until you sell. Same thing goes for when it's up. When you sell, you've captured that gain and you're not going to give it back again. And at that point, you can use it for other purposes, whether it's reinvesting or buying a house. Yeah, you had a question back there.
I know you have a weird question.
Okay.
The place where I was exposed to most of this was through like my financial peace university class.
Yeah.
Is there anything that you disagree with or you want to add on to, like that course, or like as a financial
Yeah.
planner? I think this is also really important, or something I think would be really beneficial and highlight.
Yeah. I like financial peace. I think Dave Ramsey does a great job with financial peace. So what we have here is a complement to it, or it's an alternative to it. But I don't disagree with any of the teachings and so forth that's in financial peace. A lot of it, and you probably recognized a lot of the principles from kind of the first part of the presentation that I was talking about. I'd say if there would be something that you maybe complement financial peace with, Dave does a great job at teaching folks solid principles of, when you're starting off, and he's telling a lot of the same things about compounding interest and put away and get out of debt, build an emergency reserve fund, go buy term insurance, all of that, and that's all important. The one thing I would say that you might complement it with is, doesn't maybe talk as much about retirees as far as distribution planning and things like legacy planning when you've already kind of gotten past that and you've become financially successful. Be the only thing that I'd say. So I wouldn't disagree with anything that he puts in there. It's all great, and it's a great base. So if you look at that pyramid, he does a wonderful job at kind of building that base, building the things that are important to get you on the right track. I would say if there was anything, and it's not a critique, it's just not what it's designed for, it would be to complement it with kind of those top tiers of the pyramid to take it one more step. Okay. It's a good question. Any other questions?
I might make a comment,
Yeah,
if you don't mind.
sure.
Yeah. is more pertains to the denomination
Mm-hmm.
that we haven't discussed. As you enter the ministry in the church, there is a pension plan in the Church of the Nazarene, but it's called a defined benefit
Mm-hmm.
as opposed to a defined.
Contribution. Yeah.
Okay, they're very different.
Yeah.
So there are people who get frustrated when the pension is not a big pension like a school teacher gets, or a fireman, or a policeman, or other workers, because it's a defined benefit. Means everybody shares the same amount, but the money has to come from somewhere. So you as a minister qualify for a contribution that the big pool from all the churches that share, some of it will go to you. But it's not enough to live on. So you have, because no more money is coming from any other source to make it grow. And people that get frustrated that it's not enough money to live on don't realize they didn't put anything into it. So the churches they share to this fund, and everybody gets the same amount according to the time they serve. And so it doesn't depend on you put more so you get more, or you paid less or you get less. It's an equal share. So it's not intended to cover all your retirement. It's to help you with your retirement. So your Social Security, it's assumed that you'll stay in Social Security and you won't opt out, although pastors can opt out.
Yep.
It wouldn't be very smart, but you can. And then the third thing is what Matt is talking about, that you have to take care of your own business and add to the what's already been put aside for you by the church in the defined benefit plan.
Yeah.
Sounds a little complicated, but I'm sure that most of them have heard this even from our own inside experience. So I just thought I'd tell you.
No, and I didn't know that. And John raises a good point. A defined benefit plan, that's huge. Meaning most folks don't get that. Companies today, and in essence, it's a pension. Private companies today are getting as far away from those plans as they can get because they cost a lot to fund, and people are living longer. And so, again, it takes a lot of money to fund those pension plans. So that's an excellent kind of piece or baseline income that will be in all of your retirement plans. So he's exactly right. You'll have several different sources that ultimately fund your retirement. One will be Social Security, assuming you don't opt out. And I agree with John, stay in. The only way, if you do opt out, please save the money that was supposed to be going into Social Security somewhere else. Because sometimes, pastors neglect to do that. They'll opt out of Social Security, but then not save what it would have been going towards their Social Security benefit. But you'll have a pension, you'll have a Social Security benefit, which will provide a baseline income, and then you wrap around that with your savings. And that's what we've been talking about. And the sooner you can get started, the better. The sooner that you can just get money put away, the stronger position that you'll be in. So, yeah.
I know as church treasurer
Uh-huh.
for many years, our pastor in his package
Yep.
that he got when he came to our church, part of it in his salary was an annuity,
Uh-huh.
which we gave him, and then he vested that into, at the time, it was Fidelity.
Yep.
Okay.
Yep.
So there he was already starting to put money away. It was part of his salary,
Mm-hmm.
but, and he could have opted, like, maybe he said, well, take my car allowance and take something else, and instead of giving me that, give me an annuity,
Right. Right.
But then you get into what's taxable and not taxable, so you gotta keep track of all that.
You do.
But that is another way to do it, is
Yeah.
have that part of your salary package and have them give you separate check for annuity, and then you take care of that.
Which is huge, and it's just doing good disciplined saving, and we talk about it all the time. Ramsey talks about, you just automate it, right? And you don't see it, and you don't feel it, and so you don't even realize it's gone, right? And you just learn to live without, and ultimately he'll be incredibly, if he's approaching retirement, he'll be incredibly happy that you did that for him, and that that decision was made, and again, didn't know any better, right? You just never saw it, it was never there. You just you learn to live without it, and ultimately has a comfortable retirement.
And one other thing too is like when it came around for periodic raises,
Mhm.
sometimes he'd say, well, just apply that to my annuity.
Yeah.
And don't give it to me in my base salary or whatever.
Which is smart.
Yeah.
Which then your savings keeps pace with inflation, which is another thing. And that's when we talked about, you know, some of those graphs. Hopefully there wasn't too many graphs for the crowd. You know, one of the comments I made was that, you know, I was assuming a $5,000 contribution that never went up. And that's not realistic. You know, the realistic scenario is that you save a certain percentage from your paycheck. And then as you get cost of living increases, even if you don't do what your pastor did, which was smart, but that percentage stays the same, but the dollar amount goes up. And so naturally what ends up happening is you start saving more and your savings keeps pace with the inflation rate, which is just smart to do. Any other questions? Or comments?
Time for the test.
Yeah, time for the test. One of the things we did, so again, we left you some financial literature. Again, we tried to get about 4 weeks worth of information here in just about an hour's worth of time. Those booklets are yours, and there's some hopefully helpful tools inside of there for you to utilize. It elaborates on some of the points in further detail. There's a financial pyramid, which I think is a good visual, where you kind of see the different topics that we talked about here today and how they pertain to an overall financial situation or plan. The other thing is, if you have any questions about anything that we talked about, there's also a sheet there where you can put your name and your number, only if you want us to, but we'll certainly be happy to give you a call, someone from our team, if you have any follow-up questions on any of these things. Okay? John, anything else you want me to touch on?
I think that's good.
Okay.
Thank you.
Would you appreciate very much